Welcome everyone to the October Market Update and Economic Outlook discussion. With me is Martin Wildy and I'm Ryan Ohlson. Let's kick off with talking about the first three quarters. The first three quarters of 2022 have been the worst of any calendar year, at least for a balanced portfolio, going all the way back to 1997. And consumer and investor sentiment have really painted a bleak outlook on the market, and many people are focused on a pretty negative narrative, and they're promoting a negative narrative. We see, some news around the globe that is very troubling, and yet in the midst of all of that, I think we still have an optimistic outlook. And let's start there. What factors are you seeing that are driving that optimism?
Sure. No, I appreciate that. And I don't want to discount all the negativity out there. And in any cycle, there are always things that we can be concerned about. And certainly there are a lot of things that are going on behind the scenes that have caused markets anxiety and investors anxiety. But I think it's important to cut through and look at what's actually going on fundamentally. And when we do that, we see that a lot of what is happening in the markets so far this year is being driven by investor fear and the uncertainty around what the Fed is going to do and how the inflation environment is going to play out, or even parts of the bond market, which are down 15% or more. It's not because these companies are defaulting or they suddenly have become insolvent or not financially sound. It's really just a pricing mechanism to reflect what the Fed has been doing with interest rates. So we recognize that there are uncertainties that are still out there, and we can't predict when things will ultimately stabilize. I think there are a couple of key trigger points the market is looking for, one of them being evidence that inflation is getting under control. But ultimately, we have to look at the fundamentals of these companies and of all of these investment categories. And if we're able to buy things at a reasonable price, at or below their intrinsic value, especially for high quality assets, we think that's going to work out well for investors over time. And historically right now, we are seeing evidence when it's looking at the consumer sentiment surveys that are sent out to households, some of the most bearish readings or most pessimistic readings we've seen in 50 years. When you survey investors and ask them about their optimism on the market, some of the most pessimistic readings we've seen in the history of the survey, going back to 1987. And historically, those have been better times for long-term investors to put money to work than to liquidate and get out of the markets.
Well, and our investment committee has decided to rebalance some portfolios. Things have gotten have drifted a little farther away from where our targets were, and given the market volatility, yep. and we've decided to rebalance and yep. get back to closer to our target. What's driving that rationale? What's the reasoning behind it?
Yeah, so rebalancing is a normal part of what we do within investment portfolios, and it can happen because certain categories do very well performance-wise and become overweight our target, or in this case, in a year where the market is down significantly, down double digits, and we're in bear market territory, it can be that the target allocation we have to something like equities has drifted down and is below our long-term target allocation. So it's not that we are proactively getting super aggressive and really overweight that long-term target. It's just a mechanism for putting the portfolios back in line with where we want them to be. And we think it instills some discipline over time where, again, we're buying these assets that we like for the long term. Mm-hmm. When they're on sale, that process of rebalancing will add money to things like stocks when they're on sale. And then if we have the opposite environment where stocks do really well and they run up and now they're really overweight that target weight, we would do the opposite and be trimming things back to put them in line. So I think it instills good discipline in the portfolio management process.
Gotcha. Are there any particular asset classes or areas that you're going to focus on as you do the rebalancing?
Yeah, there are some things that, so every environment, every sell-off, every bear market creates opportunity. And I would say, as someone that's been looking at and researching stocks for a lot of my career, there are plenty of areas of opportunity right now. There are areas or some stocks are trading at or below their intrinsic value. That doesn't happen too frequently, so their liquidation value, you're seeing this in some categories. There are some dividend paying stocks that really look attractive where you get pretty high dividend yields from a company that still has attractive growth potential. Oftentimes those things don't go together. But one specific area that we're seeing that had been quite expensive immediately following what happened with COVID is biotech. So biotech, we saw this big run up after the decline related to COVID because a lot of people saw some of the advancements that are being made within healthcare innovation and being able to cure disease, improve standard of care. All of these things that are happening in the biotech world are happening at an accelerated pace. So it's never been more efficient, cost efficient, time efficient to process a human genome. We see the whole way that diseases are being approached. It's gone from being very generalized to treating every patient the same to being much more targeted, having treatments and therapies that will work more specific to your biological makeup. And there are lots of companies that are doing really exciting things that are selling at some of the cheapest levels that they've traded at in 20 years. So we don't believe that because the Fed is raising interest rates, because we have inflation in the system, because of some of what's going on geopolitically, that has diminished innovation within an area like biotech, or that it's taken away the need for curing and improving standard of care in a lot of these important health areas. But the stocks are trading at very relatively cheap levels when compared to history. And that's something that we want to take advantage of, right? We think there's a good long-term opportunity, good long-term growth potential, good tailwind for that industry. And if that happens to be on sale because of what's going on with the Fed and what's going on with markets more broadly, we want to take advantage and add that to the portfolios in a more dedicated manner. So that's something we're in the midst of doing.
Great. So in a turbulent market like this, and there have been some pretty significant swings in the market in the indexes like Dow Jones, S&P over the last couple weeks. How would you encourage or how would you advise an investor to kind of fix their gaze to avoid some of the ups and downs, the significant swings that might kind of pull them in emotionally in a way that is not going to be helpful for making clear-headed decisions and things like that?
Yeah, and you bring up emotion, and it's a big part of investing. And no one likes to see, no matter how many times you've been through it in the past, no one likes to see these cycles where portfolios are down in value and you open up your statement and you see kind of the big decline. And I think also adding to this, a lot of the financial news media, right? They're incentivized, they want viewers, and they like things to be dramatic and very exciting, and that can be on the positive or on the negative. And I would say when you go back and you look at prior cycles, the financial media does a pretty bad job and tends to whip people into these negative frenzies at usually the wrong time. I think one of the things you can do to just get through this, one is focusing on the fundamentals of what we're doing, the fundamentals of the companies that we're investing in. If you're an owner, a part owner in one of these companies through the shares that you hold, and that stock is down 20 or 30%, you still own the same proportion of that company, and that company may actually fundamentally be doing just fine. They actually may be doing really great things, but you don't have to accept that market price decline or that 30% discount unless you're a forced seller. And the other thing that we do that I think people should focus on for the long term, when we build portfolios, we do this specifically for each client. And we understand the liquidity needs of the client situation. And we also build portfolios where if there is a specific need where people need to draw funds from the portfolio, we can do that without selling the things that are trading at very unfavorable levels. We can do that by selling some of the liquidity positions, things that have held up well within the portfolio. And we typically design portfolios with enough of a buffer that we don't have to at inopportune times sell things that we don't want to be selling. So I think people should focus on those two aspects.
Okay, that's great. As we monitor the Fed and the decisions that they're making with regards to interest rates, what sort of labor figures do you think will bring the Fed to a position of easing back or maybe ceasing interest rate hikes? I mean, we've talked about the dual mandate that the Fed has, and I've said several times while inflation continues to be on the rise and maybe took a downturn just recently, but still, while that one, we're trying to get that under control, labor seems to be just fine. The figures have been fine. But what change in that labor picture would cause the Fed to ease back or cease on increasing rates?
Yeah, no, I think it's a reasonable question, and it's one that I wish I had the specific. at this line, the Fed will stop raising rates. But ultimately, what happens? It's a feedback loop, and the Fed right now is trying to fight inflation. They fell way behind on getting inflation under control. They thought it was transitory and just supply chain related. Turns out there were other factors at play, and now they're playing catch up. They're raising rates aggressively, and they're talking a really tough game because they need to get inflation under control. But you're right, the Fed has a dual mandate. They want to get prices down, but they also want the labor market to be healthy and people to have full employment. So what they are watching is indications. So right now, the labor markets remain very healthy. There are still lots of job openings. I will note, though, just over the last couple of months, we've seen the number of job openings drop from about 12 million down to 10 million. It's a pretty big decline in a short period of time. Still a lot of jobs out there. So no real concern. But that's a precursor sometimes to companies pulling back and starting to change how they look at their hiring picture. And if the Fed starts to see unemployment, the rate's been very low, hovering between 3.5% and 4%, so near 50-year lows. If we start to see a combination of openings keep coming down, layoff announcements, and that unemployment rate starts drifting higher, and some of the weekly claims numbers start to come in on the high side for unemployment insurance, I think you'll start to see the Fed change their calculus pretty quickly. And the Fed, they're very data-driven, very data-dependent. So even though they've talked about we're going to raise rates for the foreseeable future and we're going to really get inflation under control, if the labor market starts to show signs of deterioration, so if that trend changes and it's enough to convince the Fed that they're really starting to cause an issue there, they'll back off very quickly. And my expectation is they would stop raising rates and then quickly pivot if they need to actually cutting rates. And they can do that within a very short period of time. And that's sometimes, I think that gets forgotten by investors and by the market as a whole, is just how quickly the Fed can pivot if they want to.
Gotcha. Is there much of a lag in the indicators that you mentioned, like with unemployment and things like that? Like how much of a time lag from when it's like actually happening, to households, actually happening to corporations, and then when the numbers are shared, and is there what's the lag time in there?
Yeah, it varies depending on the different metrics. So they're within the economy, we get lots of different data points, weekly, monthly, quarterly, showing how the economy is doing across all these different categories. Some are lagging indicators where really that doesn't show up in the data until well after the trend is in place. Some are coincident where it's happening at the same time, and then some are leading. So what the Fed is trying to focus on future decisions are more of those data points that have tended to lead economic activity. So an example might be, instead of looking at home sales, right, you would be looking at people applying for permits to build a home. So this would be more of a indicator of future economic activity as opposed to what's happening today. So same thing happens in the labor markets. I mentioned job openings. That can be a precursor to actual layoffs. And layoff announcements can be a precursor to the unemployment rate ticking higher. So each of those factors, they can lag with different periods of time, but there are distinct categories, and the Fed's well aware of that and is trying to look at those leading indicators when they're making decisions.
So in this kind of an environment, it wouldn't be too much of an assumption that if we saw a decrease in job openings, that could be the precursor to layoffs. It's not a decrease in openings because people have filled those positions.
Right. It can be a
could
combination, but
Yeah.
that's something. I mean, typically you would see openings come down, then you'd see layoff announcement, you'd see a spike in unemployment claims, and all of these things would happen. So the weekly unemployment claims, that would all happen before you actually see a rise in the official unemployment rate as it's calculated.
Gotcha.
So those would be more important things for the Fed to focus on in the labor market.
Something we have touched on in the past was the strength of the dollar.
Yep.
And that even though there is volatility in the U.S. markets compared to other global markets, it's been a safe haven for investors. And the U.S. dollar continues to strengthen. How does that help with inflation, though? What's the connection there?
Yeah, and if you're thinking about taking a trip to Europe or the UK, I mean, it's really favorable right now because of how strong the dollar has been. So when you see those other currencies, they're trading at relatively weak levels. And that can also impact inflation in the following way. When we are buying goods and services, so we import goods and services from overseas, we're basically paying for them in the local currency. So let's say you've got a European company that's making widgets, and those factor into they're an important part of a product that's made here in the US that we end up consuming. Well, if that widget is priced in €3, then it's probably going to stay priced in €3. But if the dollar gets a lot stronger versus the euro, I can buy more euros with my dollar. So although that price didn't go down, it's still, the sticker price is still €3 per widget, essentially to a US buyer of that widget. As the dollar goes up and appreciates by 10%, the true cost of buying that has declined by 10%. So that happens across a lot of different goods and services where we are importing pricing. A strong dollar is essentially very disinflationary because our dollar goes further. We're able to buy more. So it's pushing down kind of the price inputs from those different goods that we're importing. Now, if you're an exporter, it works against you in the opposite direction. But when we're looking at inflation data, a strong dollar tends to be good for keeping inflation under control. So higher interest rates should get inflation under control. We're starting to see that in the housing market. Interest rates have driven mortgage rates significantly higher. That starts to really decline, put a pressure on home price appreciation. We also saw the data that just came out on rent increases. We actually saw decreases in rents on an average basis, really for the first time going back a couple of decades. So we're seeing a change in some of the real-time pricing, and this stuff should feed through into the official inflation data. It's not going to happen overnight because of how inflation is calculated, but these are all indicators that we think inflation is going to start to moderate, and especially as we get into the end of this year and early next year, because the comps get easier. Remember, we're measuring inflation. If $4 gasoline is being measured versus what we paid for gasoline a year ago, right? Yeah. So if gasoline was $2 a year ago and it's $4 today, we've had a doubling in the price of gas. However, if you fast forward and gasoline doesn't go up, but it's still high, it's still $4, but now being compared to $4, your inflation has just gone to zero. So that's, I think, going to help bring down some of the official inflation numbers too, is just the math of comparing to higher levels as we roll through time.
I see. Okay, that makes sense. So, and even too, I would think as the basket of goods that are used for inflation, people are substituting some things maybe as well, right? So that would play into it if there are substitute goods that people have said, I'm no longer going to purchase this. It became too expensive. I'm now going to be purchasing this. That would also play into the inflation comparisons as well.
Yeah, it reduces demand, and that ultimately will feed through into pricing.
So related to the things that we're doing as part of our optimistic outlook, I guess I want to pick your brain. What are some of the things that we're doing in our portfolios to add value, to take advantage of what's going on in the marketplace, but to add value for our investors?
Yeah, so I mentioned rebalancing, adding to some things that have really been beaten down, adding to areas that we haven't had dedicated exposure that we think are really interesting and on sale, like biotech. But also, I think within fixed income, we've been pretty pessimistic on fixed income for some time now. I think, and I think that's paid off this year, in that bonds have really had a very difficult year with higher interest rates and higher inflation, and just big losses in the bond indices across the board. And some of the alternative strategies and hedging strategies that we've been using in lieu of bonds, we think that combination of things has helped hold up better on that part of the portfolio for non-equities. So that's something we continue to keep an eye on. At some point, bonds will become more attractive again, and certainly as interest rates move up, we're starting to see that. But so far, positioning the non-equity portion of the portfolios the way we have this year has been beneficial.
Good. One last question, and then feel free to add other comments that you'd like to this. But we're always on the lookout for private investment opportunities, things that come our way either as a recommendation from a client or just things that we become knowledgeable of through our network of things. Are there any things in particular that you're seeing as that you're optimistic about in the alternative space?
Yeah, I would just say for folks who have committed to some of the private investment funds where there's a capital call process where that money gets drawn down over time, you may have noticed that it's taking longer to put money to work in many categories, and I think that's a good thing. What's happening is there's been a lot of dislocation in public markets. Interest rates are higher, multiples have come down, so private markets are really starting to feel the effects and are starting to have that negotiation occur when deals are being signed and done. It's happening in parts of real estate. It's happening in private debt and venture capital. A lot of these areas where the fund managers are going out and they're trying to invest in deals, but you've got these entrepreneurs in the example of venture capital where they think their business is worth a lot because they're doing great things, they're growing really quickly, and then you have to go back to them and say, well, I know you think your business is worth this multiple, but look at what's happening in the world around us. And they talk those multiples down, or the prices they're willing to pay. In that negotiation can take time, but ultimately it results in getting better pricing for investors. So I think a lot of what's going on in public markets is also spilling over and creating good deals in private markets. So if you see that time period where the capital calls aren't happening as quickly as maybe you expected, keep in mind it's not a bad thing. It just means those managers are really pushing back on pricing and trying to be very selective. So I think there's lots of opportunity in a lot of different asset categories. And we, as you mentioned, we diligence lots of these things, public and private. And ultimately, different strategies are suitable for different investors. And we certainly try and make people aware what we think makes sense in their specific situation.
Well, I really appreciate you taking time to walk through the things that we're doing. Again, in the middle of what's been a really difficult year so far, from one narrative, has created opportunity for us as we maintain a long-term focus, long-term objective. It's going to create opportunities ongoing as we go through. It's really important. I hear you say this, underscoring. It's really important that investors stay focused on their objective, their investing objectives, and also stay focused on, just because markets fluctuate does not mean that the things that they're holding, things that they're owners of, have actually lost value. It's just a price. It's just a price tag on it right now.
It's not necessarily a permanent impairment of these assets.
Good.
And that's different.
Yeah, very different. Well, thank you for your time. If you have any questions about any of the things that we talked about today, please reach out to your service advisor, or also there's information at the bottom of the screen. You can ask any questions. We'd also would love your feedback on this video and how to make it these kinds of interactions more valuable to you. So thank you, Martin.
Thanks, everybody. Thank you, Ryan.